Welcome back to the Deep Dive. It is Monday, February 2nd, 2026. Today, we are playing detective with a story that, frankly, feels like a glitch in the Matrix.
It really does. It's one of those situations where the logic just doesn't seem to add up at all.
We're looking at a company sitting dead center in India's biggest economic boom. I mean, clean energy. They have the factories, they have the patents, and they just told the world they're making a strong recovery with profits up. But here's the catch.
There's always a catch.
As of right now, their stock price is bleeding out at a fresh 52-week low.
It's the ultimate divergence. You've got the boardroom saying we're back and the stock market saying we are leaving.
Exactly. We're unpacking Servotech Renewable Power Systems Ltd.
Yeah.
We have fresh data from January 31st covering their Q3 performance, stacked up against a technical analysis report from January 30th that looks, well, it looks like a crime scene. Our mission is to figure out if this is a massive misunderstanding, a hidden gem the market is ignoring, or if the charts are seeing a fatal flaw that the glossy presentation is hiding.
It's the green ambition versus the red charts.
So let's get into it. For you, the listener, who hears Servotech and maybe thinks it's just another pop-up startup riding the solar hype train, let's ground this. Who are they actually?
That's the first misconception we need to clear up, you know? This isn't a PowerPoint company that just incorporated last year to grab some government subsidies. Servotech has been around for 21 years.
So they've survived a few cycles. They were doing this before it was cool.
Decades before. They're a legitimate, established player in power and innovation with over 500 employees across India. And physically, they're substantial. We aren't talking about a rented co-working space.
Right.
They have 2 state-of-the-art manufacturing plants in Haryana, specifically in Kunli and Safiabad.
And they have a warehouse too, right? I saw that.
Yes, an automated warehouse in Hunpur. So when we talk about Servotech, I want you to visualize actual machinery, conveyor belts, and R&D labs. They are bending metal and soldering circuits.
Okay, so they have the physical footprint. They're making things.
Yeah.
But what exactly is coming out of those factories? If I walked into the Kunli plant, what would I see on the line?
You can really break their business down into 3 main pillars. First, you have solar. They manufacture the actual panels and the inverters, you know, the brains of the setup.
Okay.
Second is power backup, specifically lithium-ion batteries. And third, and this is the big growth engine everyone is watching, is EV charging.
I was looking through their product portfolio visuals, and I kept seeing this brand name, Sultan. It didn't look like high-end, sleek Tesla gear. It looked pretty rugged.
That is a crucial observation. Sultan is their brand for batteries, but look at where they're deploying them. They aren't just targeting luxury EVs. They show these batteries installed on e-rickshaws.
3-wheelers.
Yeah.
Of course.
The 3-wheelers that are the absolute circulatory system of Indian transport, that tells you something about their strategy. It's gritty, it's street level. Their philosophy is produce green to live green. But practically, they're selling consumables to the massive fleet of working-class vehicles on the road.
So they're embedded in the real economy, not just the luxury economy.
Yeah.
That's a key distinction. Now, let's fast forward to the present day. We have their Q3 FY26 performance report, which just dropped. What is the narrative coming from the top?
The narrative from Mr. Raman Bhatia, the founder and MD, is basically, the storm has passed.
That implies there was a storm.
Oh, there was. He admits that Q2 was rough. He used the word challenging.
In corporate speak, challenging usually means disastrous.
Usually, yes. It means margins got squeezed, maybe sales dipped. But the pitch for Q3, the quarter ending December 31st, 2025, is a strategic reset. He claims a strong sequential recovery.
Okay, but you can't just say we reset and expect people to believe it. What evidence are they offering? How do they turn the ship around in 3 months?
They point to 3 specific levers they pulled. 1, improve cost discipline, so they stopped leaking money on overhead. 2, better manufacturing execution, which means they got products out the door faster and with fewer errors. And 3, a favorable product mix.
That product mix part is interesting. That usually means selling more high-margin tech and less low-margin commodities.
Precisely, and that ties directly into their innovation pipeline. This is where the story gets technically very interesting. They highlighted a newly granted patent for something called CCS2 to GBT EV charging conversion technology.
Okay, hold on. That is a mouthful of acronyms. CCS2, GBT. Why does a regular investor or, a driver care about this alphabet soup?
This is actually a massive deal. I mean, think of it like the early days of smartphones. You had Apple chargers, Android chargers, all those weird proprietary brick chargers. If you didn't have the right cable, you were just dead in the water.
Like the dongle hell era.
Yeah.
I remember it fondly. We're not.
Well, the EV market is currently in dongle hell. CCS2 is the European standard that a lot of premium cars use. GBT is a standard used widely in China and by many Indian manufacturers, especially for the smaller vehicles. They just don't talk to each other.
So if I pull up to a CCS2 station in my GBT car, I'm stranded. I have fuel or electricity right there, but I can't get it into my car.
Exactly. Until now. This patent allows Servotech to build a bridge. It creates interoperability. By owning the tech that lets these different standards connect, Servotech is essentially building a universal translator for electricity.
That's a vote. In an infrastructure race, the person who builds the universal adapter usually wins because everyone needs them.
It creates stickiness.
Yeah.
It makes their chargers the safe option for network operators because they can service more types of cars, and they aren't stopping there. They've also officially ventured into the EV three-wheeler battery market with that Sultan brand we mentioned.
Which makes sense. Instead of just waiting for the government to build giant charging stations, they're selling the batteries directly to the guys driving the rickshaws today.
It's smart diversification. One is a long-term infrastructure play. The other is a fast-moving consumer good, essentially. Batteries wear out. They need replacing. It's recurring revenue.
And speaking of projects that build reputation, I saw they're involved in a solar rooftop project in Andhra Pradesh.
The NRE DCAP project.
Yeah.
It's aimed at underserved communities. This is important not just for the revenue, but for the resume. It proves they can execute government-aligned social impact projects.
Which brings us to the elephant in the room, the government. A company doesn't operate in a vacuum. If we look at the macro environment right now, in February 2026, it feels like the stars have completely aligned for Servotech.
On paper, the macro tailwinds are hurricane force. You simply cannot ask for a better policy environment.
We're talking about the PM Surya Ghar Muft Bijli Yojana.
A massive scheme. Let's look at the numbers because they're just staggering. The government's goal is to transition from 4 million solar households to 10 million households by March 2027.
Wait, March 2027, that's next year.
That's roughly 13 months from now. They want to solarize 6 million new homes in just over a year.
That's incredibly ambitious. That is a lot of panels.
It's a logistical sprint. But here's why it matters for Servotech. They specialize in 1 to 10 kilowatt residential systems. They aren't trying to build massive solar farms for the grid. They are building the exact size units that this government scheme is funding.
So the government is effectively acting as the marketing department for Servotech's core product.
And the bank. They're subsidizing the purchase. Plus, you have the broader Net Zero 2070 commitment steering the whole economy.
Okay, so let me just try to summarize the bull case here. We have a 21-year-old company. They say profits are recovering. They have a patent that solves a major headache in EV charging. And the government is trying to rush 6 million customers to buy exactly what they sell in the next 12 months.
That is a very, very compelling pitch. If you just looked at the slide deck, you'd think the stock would be flying.
So why in the world is the stock chart screaming abandoned ship?
This is the paradox. We have to take off the optimistic founder hat now and put on the cold, hard analyst hat. We have a technical report from January 30th, just a few days ago, and it is ugly.
How ugly? Give us the damage.
The stock closed at 59.05 on the NSE. But more importantly, it just hit a fresh 52-week low of 57.51.
Ouch. So while the founder talks about recovery and reset, the price is hitting rock bottom.
And it's not a sudden crash, it's a slow bleed. The report shows a significant long-term downtrend. The stock is trading well below its 50-day and 200-day moving averages.
For the listener who doesn't stare at charts all day, what does being below the moving average actually signal to a trader?
It just signals weakness. It means the momentum is broken. Every time the stock tries to stand up, it gets shoved back down. The average price people paid over the last year is much higher than where it is now, which creates a lot of bag holders looking to sell the moment they break even. It creates a ceiling of resistance.
I saw one number in the report that really jumped out at me, the RSI. It was 13.5.
Yeah, that number made me do a double take.
Decode that for us. What is RSI?
RSI stands for Relative Strength Index. It measures how fast and how heavily the price is moving. It's on a scale from 0 to 100.
Okay. And what's normal?
Well, anything between 30 and 70 is considered normal noise. If it drops below 30, the textbook definition is oversold. It implies the selling has been too aggressive and a bounce is likely.
And Servotech is at 13.5.
13.5 is deep in the basement. It's panic territory. It is statistically rare to see a stock stay that low without some kind of reaction. The money flow index, the MFI, is telling a very similar story. The selling pressure has been relentless.
So we have a strong sell signal from the trend, but an extreme oversold signal from the RSI. This feels like a game of chicken. Does 13.5 mean the company is going to zero, or does it mean it's on sale?
That is the conflict. A contrarian trader sees 13.5 and thinks, dead cat bounce. Even if the company is in trouble, it's been beaten down so hard it has to snap back like a rubber band stretched too far. But
There's always a but.
the report also mentioned volume. It noted that volume spikes, meaning lots of shares changing hands, have occurred specifically during the price drops.
Which means people aren't just selling, they're fleeing.
It indicates heavy distribution. Big players might be exiting. It suggests that the smart money might not be buying the strategic reset story just yet. They might be seeing risks that the press release glossed over.
Well, let's talk about those risks. Servotech isn't hiding them entirely. I looked at their safe harbor statement in the presentation. They list a few things that could derail the whole train.
They do, and we should pay attention to them. Raw material volatility is a big one.
We're talking about lithium, copper, silicon.
Exactly. These are global commodities. Their prices swing wildly based on geopolitical events, mining strikes, you name it. Servotech mentioned improved margins in Q3, but if lithium prices spike next month, those margins just evaporate. They don't control the cost of their ingredients.
And then there's the competition. We mentioned the patent, but they aren't the only sharks in the tank.
Intense competition. In the EV charging space, they aren't just fighting other startups. They're fighting giants like Tata Power, GOB, and global players entering India. Having a patent is great, but Tata has billions in capital. That's a tough fight. A better mousetrap doesn't always win if the other guy can blanket the city in marketing and loss leaders.
And we can't ignore the policy risk. We said the government is the wind in their sails, but winds can change.
Absolutely. They are heavily dependent on schemes like PLI, the production-linked incentive, and FAME. If the government delays a subsidy payment, which happens all the time in the sector, or changes the eligibility rules for the Surya Ghar scheme, Servotech's cash flow could take a massive hit.
It's the double-edged sword of government reliance. They give and they can take away.
We should also add a quick disclaimer here. Servotech explicitly states that the third-party industry data in their report hasn't been independently verified. So when they say the market size is X, you have to take that with a grain of salt. It's marketing material as much as it is a report.
So let's try to pull this all together for you. We are staring at a fascinating disconnect.
It really is the classic struggle between fundamental value and market momentum.
On one side, we have the story. 21 years of history, a claimed turnaround in profitability, a universal translator patent for EVs, and a government obsession with solar.
And on the other side, we have the chart. A price of 59, a 52-week low, and an RSI of 13.5 that suggests the market has completely lost faith regardless of the news.
It highlights a key lesson for anyone learning about markets: the difference between a company and its stock.
They are not the same thing. That is the hardest lesson to learn. A company can be improving operations, fixing the factories, getting patents, hiring smart people, while the stock is still being punished for past sins or broader market fears. Sometimes these two realities move in opposite directions for months before they finally crash into each other.
And that convergence can be violent. Either the stock skyrockets to catch up with the reality, or the company's reality cracks to match the stock.
That's the gamble. As Benjamin Graham, the father of value investing, said, in the short term, the market is a voting machine, and right now, the voters hate Servotech. But in the long term, it's a weighing machine. The question is, what will the weighing machine say when the Q4 numbers come out?
It is certainly a situation to watch closely. We aren't giving financial advice here, but looking at an RSI of 13.5 on a company in a boom sector, it definitely makes you pause. It makes you wonder if the market is being irrational, or if it knows something we don't.
It raises a very provocative final thought for everyone listening.
What's that?
With the technical indicators screaming oversold, louder than we've seen in a long time, and the government pushing for 10 million solar households by next year, ask yourself this. Is the market seeing a fatal flaw in Servotech that we aren't? Or is this simply the darkest moment before the dawn?
A falling knife or a hidden gem? We will let you decide. Thanks for joining us on this deep dive into Servotech. We will catch you on the next one.